What if I told you that sometimes central banks create huge amounts of money, but most people don't even notice it in their daily life? This tool is called quantitative easing, or QE, and many people confuse it with money printing. But they are not the same thing. Let's break it down simply. QE is not used in normal times. It is used when the economy is in trouble. There are three main situations. First, banks stop lending. After a financial crisis, banks become scared. They stop giving loans, businesses can't expand, people lose jobs, and the whole economy slows down. Second, interest rates are already zero. Normally, central banks help the economy by lowering interest rates. But if rates are already at zero, they cannot go lower, so the normal tool no longer works. Third, deflation risk. Deflation means prices are falling. It sounds good, but it's dangerous. People start thinking, I'll buy later when it's cheaper. So they stop spending. Businesses earn less. They cut jobs. And the economy goes into a downward spiral. So what exactly is quantitative easing? Here's the simple definition. Quantitative easing is when a central bank creates money digitally and uses it to buy financial assets like government bonds. Not cash for people, not direct spending, but a financial system intervention. Now let's understand how QE works, step by step. Step 1. The central bank creates digital money, not physical cash. Step 2. It buys government bonds from banks. Step 3. Banks receive money and gain liquidity. Step 4. Interest rates fall, making borrowing cheaper. Step 5. The economy restarts. Banks are encouraged to lend again. Businesses invest. People spend. Now let's clear the confusion. Money printing versus quantitative easing. Money printing is simple. The government creates money and spends it directly into the economy. People receive money immediately. This can lead to high inflation risk. Quantitative easing is different. The central bank creates money. It buys bonds from banks. And the money enters the financial system first. It is indirect and controlled. Here's a simple analogy. Money printing is like giving cash directly to everyone in a town. QE is like pouring water into the town's main pipes and hoping it flows through the system. Let's take a real example. During the 2008 global financial crisis, banks stopped trusting each other. Credit markets froze. The economy was collapsing. So the central bank stepped in. The Federal Reserve launched massive QE programs. They bought government bonds and injected trillions into the system. And the result? Markets stabilized, interest rates dropped, and the economy slowly recovered. But there was also a side effect. Asset prices like stocks and housing went up strongly. So let's summarize. QE is not traditional money printing. It is a tool used in emergencies when banks stop lending, interest rates are zero, or deflation threatens the economy, and it works by injecting money into the financial system to restart economic activity. So next time someone says, the government is just printing money again, you can reply, it might actually be quantitative easing, and that's very different.